Chance, we were just talking about the difficulty of owning great companies, great stocks, but maybe are a little bit overvalued, depending. How do you manage that in clients' portfolios?
Well, what we do is we're really trying for each client that has a stock portfolio with us to buy in at valuations that we think are undervalued for the businesses we want to own. And there have been times over the last handful of years where some of these great tech businesses have traded at great valuations. And then once we get a good entry point, we like to hold them as long as the fundamentals continue to deliver by those companies. So for businesses that were trading at better valuations in 2018, 2020, the end of 2022, we're able to buy in. But for instance, new clients that may have signed up with us this year that have stock portfolios, we're not buying tech companies for them yet at these valuations. There's a natural ebb and flow in the valuations of these businesses, and we'll get another opportunity to buy in at better prices, better price to earnings ratios, or free cash flow yields over the next year or two. And then we'll be able to hold those stocks for the new clients going forward after that. But we really want to be mindful of the price we're paying for each position in our clients' accounts.
Understood. Chance, just stepping back a little bit and taking a look at people's portfolios right now and understanding that you're more on the defensive front, what does that mean in terms of how you shape a portfolio, where you want to be overweight, what sectors you want to be in, how you match the fixed income versus equities?
So this year's been different for us. We've probably increased our allocation to defensive sectors in our client stock portfolios by about 15%. So that would be in consumer staples, healthcare, and utilities. Those are sectors that tend to trade almost at a relative multiple compared to the overall market. So when they start to trade down and you've got an S&P 500 price to earnings ratio of 19 like you do today, that tends to be a good time to try and rotate in the defensive sectors, and you'll see some outperformance. Those aren't positions that are going to double in value over a few years, but it's a good place to be to try and hold your purchasing power, generate some return, and then wait for the next opportunity to rotate back into cyclicals. So we had a
Hmm.
lot of exposure to more cyclical and faster growing businesses last year that we've held on to for some of those legacy clients. And then we've been pushing them more into defensives. And now we're sort of just waiting out to see some of the sectors we've avoided this year, like consumer durables, energy, and cyclical commodities. There'll be an opportunity perhaps in the next year for us to allocate more to those sectors. But right now, at this point in the cycle, it's not the best time to do that.
And Chance, out of curiosity, I mean, obviously it sounds as though you do choose specific stocks for your clients' portfolios, but for some of those sectors, do you just buy the ETF, a utilities ETF or an energy ETF versus buying the specific companies?
You could. We prefer to really try and drill down to the specific stock level because within any sector, there's going to be some very high quality businesses out there that have competitive advantages, and that's our focus. And then there'll be some that are more speculative that are really not great businesses that are going to carry a certain weight of those sector ETFs and could be a drag over the long run if you just buy those. But for somebody who's
Hmm.
just trying to get some exposure quickly, you can buy a sector ETF.
Got it. Chance, as it relates to the fixed income portion of one's portfolio, if people think about it, and of course that's why we've seen so much money move into various money market funds, fixed income products, etc. If you can get a 5% GIC, government bond, what have you, how does that fit into your strategy right now versus riskier assets?
It's really great for investors that this option is available now because we just went through a decade where government interest rates were essentially at zero, and it was very difficult to have that as a good starting point for a portfolio. Now you can get essentially a free 5% with no credit risk in these sorts of short-term government bonds, and have that as the foundation of your portfolio, and then really set a high bar for any other allocations you want to have to riskier areas. So the nice part about this as well is with inflation having come back down to about 3%, that 5% return is actually a 2% real growth rate, which has been very difficult. That might have been the long run average, but it's been a long time since you've been able to get that and actually think that your purchasing power is growing while just owning short term government bills.
Hmm. And which is so interesting because, 2% doesn't sound like much at all, but we're way ahead of where we were in terms of somewhat of a risk-free-ish asset. We're going to take a quick break. When we come back, more with Chance.